Hello, welcome to the chapter 16 lecture video. The first one in this chapter, all new information for the most part. You've seen the earnings per share calculation in intermediate one, but we haven't talked about another earnings per share calculation that goes along with that, that's called diluted earnings per share. But before we can jump into talking about that calculation of that widely used statistic that tons of companies use that you're going to find on the face of an income statement, we have to talk about what impacts that diluted earnings per share figure, and that would be dilutive securities. So I'm breaking up these video lectures into three. The first one will focus on dilutive securities, and we'll also talk about stock warrants. The second one will talk about stock compensation plans, which you're not going to see a lot of problems on the test from that particular section, but it's good information for you to know. And then the last video will cover earnings per share and diluted earnings per share and that calculation, those calculations. The appendix I don't really cover. There are a couple of appendices to this chapter, and you're not going to see those items on an exam. So let's jump into dilutive security. So when you hear the word dilutive or dilute, you're thinking of something being watered down. The earnings per share calculation is a key indicator that investors use to determine whether or not the company is being profitable. So we essentially, at its bare bones, we take net income and we divide that by the weighted average shares outstanding of common stock. And when I say weighted average, I mean we're looking at how long the shares have been outstanding during the year, and we're multiplying the shares outstanding by a fraction of the year. But essentially, we're just taking net income and we're divvying it out in a per share number. There are different types or certain types of securities or instruments that we could have as a corporation that could potentially water down our earnings per share figure. And it could water down our earnings per share figure because ultimately, if something happens in the future with this type of security, it can increase the number of shares that are outstanding. Something like convertible stock. So if you have preferred stock that's convertible into common stock, if that stock gets converted, then you have more shares of common stock outstanding, which means you have to share the net income with more people, which means the earnings per share calculation will be lower. My denominator gets larger, my final answer will be lower. So that type of security waters down or dilutes earnings per share. There are other types of securities. And when I say securities, I just mean a debt instrument. So it could be a bond, it could be a stock, just a fancy word for some type of investment or some type of debt or equity that I may be issuing. But there are other ones in addition to convertible preferred stock. We could have stock options. And we didn't talk about options much in accounting too, but a stock option gives the holder or the investor the right to purchase the stock itself, at a specific price. And these are valuable because the stock option can be something as low as $10 per share. And you can hold the option for, a lot of them you hold them for as long as you want, but in the future, the stock price continues to go up and up and up. So let's pretend I have a stock option for something like Apple, who was trading, the last time I checked, was 147, I believe. And if I hold an option that allows me to purchase shares of Apple at $10 per share, when everybody else has to pay $147 per share, I can cash in that option and immediately turn around and sell the stock. And I paid 10 for it, but when I sell it, I get 147 per share. So I immediately make money on it. A stock option is a form of compensation that's given a lot of times to key executives to sort of keep them with the company and keep them focused on stock prices. But the point is that can ultimately water down the earnings per share calculation, because if the option is exercised, then there are more shares of stock that will be outstanding. And we also see this watering down happening with convertible securities. We're looking at debt or bonds that can be converted into shares of common stock. If it is converted, there are more shares out there. The denominator for my earnings per share calculation gets larger, and my final earnings per share number will be smaller. So in the first part of this chapter, we're really going to look at how to account for dilutive securities, specifically convertible debt, warrants, and stock options are a type of stock warrants, as well as convertible preferred stock. And then in the final video, we'll look at how this impacts earnings per share. So right now, just get your mind focused on doing journal entries for special types of securities called dilutive securities. So for convertible debt, there are actually two things that are going on with that particular instrument. That you get the benefit of a bond because with that bond, there is interest and principal, but there's also the privilege of exchanging that debt for stock. So you can decide, and that's at the holder's option, at the bondholder's option. So the bondholder can decide, oh, I don't want to be a creditor for this company anymore. I want to be paid dividends. I want to be an owner. So when they decide to, they can forego any additional payments of interest and principal, and they can become a stockholder. Now, why do we even issue convertible debt? Why would we allow creditors to become investors? Well, it allows us to raise money without having to sacrifice control immediately. Now, further down the road, we may have to sacrifice control if the bondholders decide that they want to convert, but they may not want to convert. And the other reason is packaging the security with a feature like this allows us to obtain debt financing at a cheaper rate. It just changes the market rate that we are looking at on that particular instrument. So there's some key important things that we have to deal with when we issue convertible debt. The journal entry for issuance, the journal entry for conversion, if it is converted, and the journal entry for when the debt gets retired. So at the time of issuance, if we're dealing with convertible bonds, we account for them in the same way as we would any other type of bond. So we don't have to record an expected conversion of equity. We don't have to deal with that. We just amortize the discount or premium, if there is one, record it just like a regular old bond issue. The international standards actually require that you record the debt and the equity components separately. But for convertible debt under GAAP, just record it as debt. So that entry doesn't change. You're familiar with that entry. Now, when the bonds get converted into stock, we have to use what's known as the book value method. And with the book value method, all that means is that we don't record any gain or loss upon conversion. We take the old debt off the books and we put the new equity on. So let's do an example. We have Hilton Company here with a $1,000 bond, and it's convertible into 10 shares of common stock, and we have the par value at $10. At the time of conversion, the unamortized premium is $50. All we need to do at conversion is to take the old debt off the books. So we're going to take bonds payable off the books. We're going to take the premium on bonds payable off the books, and we're going to put the common stock on. So this means we're debiting bonds payable for the $1,000. We are debiting the premium on bonds payable for $50,000. That's the unamortized premium. And now let's deal with putting the stock on. Common stock is still always valued at par. This bond is convertible into 10 shares. So 10 shares times the $10 par value is what I will credit common stock for. Now, because common stock is always valued at par, and the value, the book value of these bonds is more than par, I have to use my old faithful account, PIK, in excess of par for the difference. So the PIK account becomes my plug figure. Notice that we don't record any gain or loss. We take that old debt off the books at its book value, and we put the new equity on using par value, and we may have to use pick in excess of par if my journal entry doesn't balance. And of course, if I'm on the other side here, I possibly may have to use retained earnings if I don't have any pick in excess of par, similar to what we saw with treasury stock. But as long as I need more on the credit side, we're going to be using pick in excess of par to balance that account. Now, sometimes the corporation, we as the corporation, remember, we are the ones issuing the debt in this particular example, and the bondholder has decided to convert. When we issue debt, convertible debt, we may want the bondholders to convert to being stockholders so that we can stop paying that interest to every single period, and so that we can stop paying back the principal, and all we have to give them is dividends. So to encourage them to convert the debt into equity, we'll give them extra money, and that extra money is called sweetener, and we just record that sweetener as an expense. It's called debt conversion expense. Let's see an example with that. So with this one, right now, this corporation has $1 million par value convertible bonds. These are debenture bonds. A debenture bond is just an unsecured bond. And it's convertible into 100,000 shares of common stock, $1 par value common stock. The corporation wishes to reduce its annual interest, so they pay a sweetener of $80,000. They give some extra money of $80,000. So at conversion, you can do this as two separate entries or one big entry. We're going to take the old debt off the books and put the new equity on. We're also going to record the $80,000 in cash that we're paying in debt conversion expense, but there is no gain or loss. So there's the debt conversion expense there. There's the 80. I'm gonna put it all up here so you can see the cash. So that would be one separate entry if you wanted to do it as one entry. We take bonds payable off the books. Common stock is still valued at par, so 100,000 shares at $1 par value. And pick in excess of par is what I need to make my entry balance, as well as the cash going. Now, what about retirement? So we've seen issuance. That's what we've learned before, nothing new. We've seen conversion using the book value method. No gain or loss, take off the debt, put on the equity. Now let's deal with retirement. And with retirement, it's the same. I don't really have to do anything that they're any different. This is where I am going to see a gain or loss. If the debt gets retired before it's converted into stock, then I record that entry the same way I would as if it were not convertible debt at all. So issuance, retirement, the same. The only thing I have to worry about is conversion when it comes to convertible debt. Now let's look at convertible preferred stock. For convertible preferred stock, the option is there to convert that preferred stock into common stock. And this is usually included in equity unless there is a mandatory redemption. And with a mandatory redemption, the stockholder can force the corporation to cash in on the preferred stock or pay them back. So in that situation, if there is a call option and it's forced and it's at the option of the stockholder, preferred stockholder, then it's really debt. It's not. When you see mandatory redemption, it's really classified as debt. But most convertible preferred stock doesn't have that mandatory redemption option. So again, we use a book value method. There's no gain or loss. You take the old preferred stock off, you put the new common stock on. So very similar to what we did with debt. So this corporation has 1,000 shares of common stock that they're issuing upon conversion of some convertible preferred stock that was originally issued for a $200 premium. So here is a situation where I have to end up using retained earnings. So I'm going to take the old convertible preferred stock off the books. It was 1,000 shares at a $1 par value. Now, it was originally issued for a $200 premium. That means I had some pick in excess of par for preferred stock in the amount of $200. I'm going to put the common stock on at its par value. So that's the 1,000 shares times the $2. But my entry doesn't balance because the book value of that preferred stock was was less than the book value of my common stock. So to make my entry balance, I need to debit retained earnings. And the other situation, when we were looking at debt and common stock, things were reversed. The book value of that common stock, we needed to pick in excess of par in order to make our entry balance here. But in this situation, when you look at the book value of the common stock is only 1,200 compared to the par value of common stock, we get a full 2,000 there. So we're short by 800. We have to debit retained earnings. So the key there is don't debit pick in excess of par. You can't have negative equity in that sense. So that takes care of convertible securities, whether it's convertible preferred stock or convertible debt. Now let's move on to stock warrants. And remember, a stock warrant is really just a piece of paper or an instrument that gives the holder the option to purchase stock at a certain price. A stock option is a type of stock warrant, and we may see stock warrants issued when a corporation already has stockholders, but they want to issue additional shares of stock. And we'll see that through the use of a preemptive right, because remember, stockholders have the preemptive right to purchase additional shares of stock when they're issued first. They get that right first. So in order to secure their right, we will give them stock warrants that are usually offered at a discount price so that they can take advantage of the additional shares that are being issued first. Now, with these warrants, sometimes they are packaged with debt and other types of securities to make the entire instrument more attractive. Again, we use it to secure that preemptive right, and warrants are used as compensation for key executives. And that's where we see the stock options really coming into play there. So first, let's look at when stock warrants are issued with other securities. So packaged with some type of bond, packaged with some type of debt. Sometimes stock warrants have a limited life. So you're looking at a life of 5 years, but it can occasionally be 10 years. And after that time period, they kind of expire and they sit on the corporation's balance sheet if they're never exercised. But they are typically given a limit. So in looking at a security that is packaged with a stock warrant and some type of debt, we have to find out what portion of that price should be allocated to the warrants, what portion should be allocated to the other instrument. And I mentioned before, which is why I'm pausing, I apologize for my slow talking, but I believe I mentioned before that stock warrants, when I first introduced them, I believe I said that they can last forever. And I was wrong. I'm thinking about restricted stock, not stock warrants. That's actually one of the negatives and the drawbacks of stock warrants, is that they don't last forever. I was thinking of restricted stock. So I apologize for that. Stock warrants usually do have a limited life of generally 5 to 10 years. And we'll talk about restricted stock when we get to the compensation piece in the next video. But all the stuff I was saying before about security that's packaged with stock warrants, we're going to use our method, the same method we used back in chapter 15 when we issued preferred stock and common stock all lumped together. We used the proportional method when we knew the value of both items, or we used the incremental method when we only knew the value of one. We're going to use those same methods here to account for stock warrants and our other type of security, whatever it may be. So let's demonstrate the proportional method. First, we need to determine the value of the bonds without the warrants, and if you're looking at a problem, that's typically given to you. And we need the value of the warrants. We have to know both in order to do the proportional method. So a lot of information here. We have AT&T with some bonds that are sold for $99 without the warrants soon after their issue. So here is the fair value of the bonds without the warrants. The market price of the warrants at that time is $30. So here is the fair value of the warrants. Now, the allocation relies on estimates of fair value, which we have. We're good with that. The price paid for 10,000 $1,000 bonds with the warrants attached was par value, or $10 million. So the bonds came packaged with warrants. In this situation, these warrants are detachable warrants, which means I can separate the bond from the warrant, and I can exercise the warrant if I want to and still hold on to the bond. Or as a bond holder, someone who purchases this is from the perspective of someone who purchases this, I can separate the warrant from the bond, and I can sell the warrant if I want to. If I wanted to sell my stock option, I could sell that if I wanted to. But the key word here is that these are detachable. So because they are detachable, I have to record them separately. The total purchase price for both the bonds and the warrants was $10 million. The question is, what portion of that $10 million should be recorded on the corporation's balance sheet as warrants, and what portion should be recorded as bonds? We're going to use a proportional method to help us. So we find the fair value of the bonds without warrants. That was in that first sentence. So we take the 10 million and the fair value was 99. So 9.9 million is the value of the bonds. I'm going to record that as bonds payable. Now, I also find the fair value of the warrants, not the 9.9. I'm going to use that to help me find the value of bonds payable. The fair value of the warrants was $30, and there were 10,000 warrants. So I get 300,000. Notice that my total fair value is more than the $10 million that was paid to the corporation. So we are going to find our ratios by taking the 9.9 and dividing it by 10.2. And we multiply that times the cash proceeds. And that's how much that should be recorded. That is how much that we are going to record as bonds payable. Now we're going to do the same thing for the warrants. We're going to take the fair value of the warrants divided by the total fair value, multiply it times that cash proceeds of 10 million, and that's the amount that will be allocated to the warrants. Now the key is, again, we're the corporation issuing bonds that are packaged with warrants. We have to record debt and equity. We record the debt and the equity based on these fair values, and these are the real numbers that I'm going to use down here. Now, you can do this as one big entry, or you can do it as two separate entries. Bonds payable is always valued at par. So the bonds payable goes in at 10 million. But the cash proceeds that we're allocating to the bonds payable was based on, let me go back so you can see, the proportional method. So when we find this number, this becomes our cash proceeds. So we debit cash and we credit bonds payable at the par value. Because those two numbers are not equal, we find that the bonds were actually issued at a discount. Now, for the stock warrants, we use a new equity account called paid-in capital stock warrants. The purpose of the stock warrants is to be exercised so that they can be converted into common stock. So when that conversion or that exercising actually does happen, we reduce the paid-in capital stock warrants account and we put common stock on the books. But when it's originally issued and somebody's buying it from us, we debit cash and then we credit PIK stock warrants. Now, I know this may be a tiny bit confusing because I told you the cash proceeds, let me go back, for $10 million, which is why I like to do it as one big entry. Because when you do it as one big entry, you get to clearly see that the total cash is the combination of these two numbers, or $10 million. You can clearly see that you're going to credit paid in capital stock warrants, which results in a discount on bonds payable of that same amount. Now, it may not always work out that way, especially depending on what method you're using. But for this particular example, it does. So you can use it, do this as one big entry, or you can do it as two separate entries. Now, let's see the entry for when the warrants are actually exercised. When the warrants are exercised, every warrant typically has some type of exercise price. We recorded the warrants at their fair value of that $294,118. So all of the warrants are exercised. So we're going to take all of PIC stock warrants off the books. The exercise price here was $25, and typically that is given to you. So we take the 25 times the number of warrants, and that's how much cash we're going to receive. Common stock gets recorded at par, and the rest goes into PIC in excess of par. And we're going to see some PIC in excess of par simply because the fair value of the warrants is usually not the same as the exercise price. If those are the same, then the warrant is worthless. If the exercise price happens to be less than the actual stock price, nobody's going to exercise the warrant. Why would you? If the stock price is, I said that backwards, but if the stock price is $5 per share and the exercise price is $25 per share, nobody's going to exercise the warrant. I can get it on the open market for $5. Why would I pay $25 when I can get it for $5? So you're not really going to see a situation here where we're going to have to use retained earnings. What you need to be concerned with is that PIC stock warrants is at the fair value of the warrants on the day the warrants were issued. But the exercise price is usually going to be lower than the fair value because that's what makes the warrant attractive. Now, what if that stock price, the market price, keeps going down and down and down so that no one ever needs to exercise the warrants? Now, you can retire them through the use of an expired stock warrants account. So you can take paid in capital stock warrants off the books. But it's one of those things that I find an annoyance because it's just sitting on the balance sheet in perpetuity forever and ever and ever. Even though it's expired, it's just sitting on the balance sheet because people did not exercise the warrant, which is why a lot of corporations use restricted stock now. Now, for the incremental method, I know the value of one, but not the value of the other. So I deal with the one that I know, and then the rest of that cash price gets allocated to the one I don't know. So now let's just only assume that we know the fair value of the warrants. So the fair value of the warrants is $300,000. We subtract that from the cash proceeds of $10 million. So this is the amount that we're going to allocate to the bonds. Now, bonds are still recorded at par, so you would have a discount on bonds payable that we would need to deal with in this particular situation. So if the warrant is detachable, meaning I can separate it, I can separate the debt from the warrant, then you need to record it in the manner that I just showed you. You need to do some type of allocation. And the problem will have to tell you from a textbook standpoint, and even from a real world standpoint, they have to tell you whether or not the warrants are detachable. If the warrants are non-detachable, meaning you can't separate the warrant and sell it later on, then you record the entire thing as debt. But if it is detachable, then you do have to allocate and record the debt and the equity. Now, I've already mentioned something about the preemptive privilege that stockholders have. They can purchase new shares of stock when it's issued first, just so that their percentage in ownership is not watered down. But the corporation doesn't really have to make a journal entry. They only have to make a memorandum entry. They only need to remember that, hey, we issued some stock warrants. They may be exercised. They may be not. They may not be exercised. But that price that's on that warrant for the preemptive privilege is usually a little bit lower than the market price. All right, take a look at the walkthrough video on some of this convertible debt. Really heavy stuff, lots of information, but I have tons of problems to do with you. And we will pick up later on stock compensation plans. I appreciate your time and attention. Have a great day.